Earlier, I spoke with David Dahl, President and CEO of Canali Trust. He manages a little under $2 billion. I asked David if subprime issues have seeped into the larger credit markets, or is it relatively contained at this point?
At this point, it looks like it's contained. It looks like that the coordinated action between the Federal Reserve, the ECB in Europe to provide liquidity to the markets so that they could function orderly, it looks like that's taken place. We can see that the volatility overall in the markets is now declining and has been doing so for the better part of 5 trading sessions now. So we think that that coordinated action is playing out and that we don't really see a spillover beyond the subprime market at this point.
Turning to the Fed, do you think we'll see a Fed rate cut in September?
We'd be shocked if we don't, and that comes at us from two viewpoints, and I want to be consistent here. We believe that the Fed is absolutely a follower to what the markets are saying and doing, and we've seen a huge separation for months now between the 91-day T-bill and the Fed funds rate. And beginning back in May when this separation started to show up, it gave us an indication that the Fed was not in a position to raise rates, but most likely to lower them. And with the Fed meeting coming up on September 18th, we expect a Fed rate cut there and maybe even another, because the separation between the two tells us the bond market is already there and pricing it in.
Do you think the Fed will be able to succeed in stabilizing the markets?
Yes, absolutely. Chairman Bernanke, who pretty pragmatic academic at this point, has played his cards very tightly. And what we mean by that, we've seen the continuation of what we had with Chairman Greenspan, a Federal Reserve that is pragmatic in its actions. The move to lower the discount rate, not the headline Fed funds rate, was a stroke of genius. And paying attention to some of the commodity-based inflation watches that are out there as they're receding now, that gives the Fed the opportunity now to provide even further liquidity to the markets, which will allow for the orderly functioning. So yes, we expect them to be successful.
Well, in light of all that's happening, where do you think we'll see stocks headed in the coming weeks?
We're very bullish. Now, in the coming weeks, we think that the month of September will be volatile because, Courtney, these next couple of weeks are going to be chock full with some key economic data points. This week coming up alone, we've got consumer confidence, a couple reports coming out at us Tuesday and Thursday. We've got some Fed minutes to see exactly what they were talking about back in August, leading us into probably their discussion September 18th. And then the doozy of the week is the week following, right after Labor Day. We're going to have 4 trading sessions, and we've got employment figures coming at us. We've got price deflators. We've got a whole lot of stuff for the markets to digest. And in the coming weeks, we think there can be continued volatility, the market in a trading range. But we're very bullish roughly from the mid to latter point of September through the end of the year for sure.
And very quickly, what are you buying?
Well, we like the oil service sector. We think that the economy's in solid shape. Going back to what we opened this discussion about, we don't see subprime spilling over. The building blocks for the economy seem solid, and therefore, with that comes oil production, an area that the United States leads the world. We also like some of the consumer-based stocks, and specifically when we're focusing in there, we've moved towards the large cap end from some of the small and mid cap names and positions that we may have held.